Hello, everyone. Nice to see you guys here in the opening panel of Genesis XBT event. Let's just introduce yourselves and your background and how you ended up in blockchain space in general.
So my name is Valérie Noël. I'm a head of trading of Banksys. It's a Swiss private bank. We are managing 26 billion assets under management. My DNA is more equity and derivative. I started trading 30 years ago, and we just have launched a year ago trading custody crypto in, crypto out to a Swiss private bank.
Hi there, my name is Dickie. I'm head of distribution for Laser Digital. We are Nomura's 100% owned crypto subsidiary. We have three verticals. One is VC, the other being asset management, and then also the trading division where I sit, where we offer things like OTC liquidity alongside market making as a service.
Cool. As mentioning, Bullish digital asset exchange. We combine AMMs and traditional limit orders in our order book, and the number 3 Bitcoin spot volume exchange over the last few weeks. First got into crypto at my previous business, which was CME Group, where I helped launch the Bitcoin futures there in Asia, and it's really amazing to see how far the adoption of that product came from 2017 to 2020, which really made me want to go fully into digital assets and move over to Bullish.
The institutional assets trade, how does it look like right now, and how it will start looking like later?
Yeah, well, we have this ETF approvals waiting from US, so for sure the adoption is coming, gently but surely, and yeah.
I mean, you've got to look at where we've come from, right? In this pre-FTX world where you had a whole load of venues doing the cooking and the cleaning, that doesn't transfer that well to tier 1 institutions when it comes to managing that type of counterparty risk in the full vertical. So, we've gone through a number of really interesting life cycles now that have highlighted what needs to be improved, where the counterparty risk needs to be managed more effectively. But the actual underlying trading technology itself, the execution, pretty much just resembles, an EFX business. Your ability to trade in liquid markets and hedge that risk, has transferred over from the majority of institutions' EFX desks.
So I think post-FTX, the pace of institutional adoption definitely slowed. And it's kind of important to define what is an institution in the case of crypto versus traditional finance. I'd say in the case when we talk about institutions often in crypto today, it's generally talking about professional trading firms or smaller hedge funds. And in traditional finance, when we talk about institutions often, it's mentioning pension funds, long-only asset managers, often asset managers who manage more than the total market cap of crypto. In today's market, those institutions have not accessed digital assets in a meaningful way. However, we've certainly seen a pickup in some larger traditional hedge funds accessing digital assets again and pulling resources into building teams around the product, which has been great to see.
Thanks a lot. Harvey, you mentioned the FTX event, right? So it's interesting to hear what impact did it have on both crypto markets from the eyes of the institutions, but also on the institutional side. So Valérie, maybe you can give us some ideas about that.
It just shows you the importance of custody, regulation. You can have fraud everywhere in TradeFi, but in DeFi also. And counterparty risk management. That's something very important, and maybe that was something was missing definitely missing in FTX. So just it showed the importance for the final client to check all these custody risk, counterparty risk, and really understand the channel from the from their account to the market.
I think it did a number of other things as well. It crystallized and focused regulatory frameworks and jurisdictions that people are comfortable with versus a lot of the ones that were making a play. And I'm not, I don't want to speak ill of certain regulatory jurisdictions, but a lot of them made a play for crypto as their entry point into a broader financial ecosystem, and they just didn't get it right. There was loose regulation. It was easy to set up shop there under some kind of regulatory framework. So funnily enough, a whole load of entities that couldn't get regulated in other places flooded these ecosystems, and that got us to where we are. I think it also highlighted the difficulty that a lot of big institutions continue to have with touching spot as well, and being able to come up with an all-encompassing regulatory framework that gives them access to spot, because you have to have access to spot to be building out any kind of proper trading functions for the longer term for big institutional players. I think that regulatory opaqueness in bigger jurisdictions that led to the smaller jurisdictions coming to the front of the trading ecosystem has now, everybody's had to suddenly roll back what they wanted to do. You know, it was an enhanced due diligence ecosystem for 6 months post FTX. And we're now starting to see which regulatory jurisdictions, with the rise of MiCA, etc., are actually taking things seriously, and where you can see the next 5 to 10 years of growth in this market coming from.
Yeah, so I mean, counterparty risk management has come to the forefront of institutional focus when looking at onboarding new exchanges or new OTC counterparties. From an exchange perspective, post-FTX, we saw a significant increase in two-way due diligence. So in the past, it had often been only the exchange that would conduct KYC and AML. Now it's kind of a two-way process. We saw also significant stress testing on the exchange, withdrawal system, risk management. What are your sort of cybersecurity policies? So these are the sort of important questions now that are being asked of exchanges that perhaps weren't in the past. We also saw a number of institutions really reduce the amount of counterparties and exchanges that they deal with significantly this year.
I guess just on that, and it worked both ways, right? We saw a consolidation around higher quality counterparties in higher quality jurisdictions, and what that also did was push a lot of the lower quality creditworthiness in the ecosystem to offshore venues and exchanges, where they are still pretty much the only places that they're able to trade, and mostly in crypto only because they can't get bank accounts, for example, as well.
Yeah, quite interesting insights about but also the FTX type fiascos are not only happening in blockchain and in DLTs. So there were failures of SVB, there were failures of Swiss banks, like few of them. So what's your view there? I mean, maybe the entire ecosystem is evolving in this way, like failure after failure, everyone learns something new. So how about, like, if you would just cover a little bit on the like recent Silicon Valley Bank and Credit Suisse failures and what the institutions learned from that?
Well, I'm not to comment like on Credit Suisse, but I think it's different pattern if you compare FTX to Credit Suisse or SBV. One is compared to fraud, and yeah, fraud also happened in TradeFi. We have seen Madoff, Ponzi scheme. So it just shows you the importance of of regulator, risk management, due diligence. It's always back to basic. Actually, it's maybe people sometimes it's a little bit greedy, and there is the FOMO, fears of missing out, and just running after. We don't want to miss that, but always go back to basic. Normally, in finance there is no free lunch, so if there is free lunch, there is a massive risk.
I think also if you dig a little bit deeper through the roller coaster that crypto was for the past sort of 12, 18 months, and you put FTX to one side, the poor risk management around under-collateralized or poorly over-collateralized borrow lending, that market still hasn't recovered. There is still no meaningful borrow lending market in crypto. You get a little bit of bilateral, but everybody wants everybody else to over-collateralize, and they've narrowed the number of instruments that they're happy to take collateral in the form of. which again, that's not unique to crypto in as much as people got greedy, and it was very, very easy when rates were where they were. Now that rates are much higher and you ground crypto in sort of a macro context, it starts to look and feel a little bit more like a traditional asset class, because everybody has unfortunately got their fingers burnt quite heavily through Celsius and through things like FTX.
I wanted to also touch on the spot ETF and the approval of the spot ETF. From the institutional perspective, what are your thoughts? And is it just PR or some kind of legitimacy to the crypto ecosystem?
So the spot ETF is just an encouraging sign to give legitimacy to the industry that we're in. A lot of traditional funds I speak to say they don't want to be leaders, they want to be fast followers. So having these kind of products just gives them an easy access to at least dip their toes. Also, the investment narrative has often been around the institutional adoption of digital assets rather than some of the underlying blockchain technology, which has been exciting for price action.
I think on that as well, it's you can have the products ready. There is still a hearts and minds and ideological battle with the real money part of the ecosystem, the pension funds that are out there. Here at Laser we launched the Bitcoin Adoption Fund and the Ethereum Adoption Fund, which, although they're not ETFs, they're very much positioned as asset management platform grade products. They've got an ISIN, they look and feel like a traditional type of product that people would hopefully put into some kind of broader portfolio. And it's really finding that gateway drug in terms of underlying digital asset exposure that gets people thinking more broadly in terms of overall portfolio allocation. Having them easily accessible so that anyone with an online brokerage account can park them alongside any gold exposure or soft commodity exposure that they may have is part of it. But it's still, I still think a lot needs to be done in the overall education and use cases, real world use cases of digital assets as well.
The Bitcoin halving is coming. So what's your view on the Bitcoin halving event overall for the industry? Is it already priced in or it's not? So from the institutional's perspective.
I guess it depends on which type of client you're speaking to. From a traditional perspective, it's not been part of their investment horizon, and it's not something that's often been focused on, but a lot of the crypto native hedge funds, proprietary trading firms, market makers, who are very active in both CeFi and DeFi trading and take active interest in the underlying blockchain and DLT technology, are very interested in and excited about the Bitcoin halving. So I wouldn't say it has been priced in from a more general macro theme.
I think it becomes a bit of a self-fulfilling prophecy as well, a little bit like technical analysis at times, where if everybody thinks something's going to happen, crypto is still a retail-driven market, let's be honest, it's a cottage industry. So when there is a narrative to cling hold to, you inevitably see some price action off the back of that. I think any skewing of the supply-demand dynamics around block rewards as well will naturally have an effect as well. But I don't see huge amounts of the institutional space gearing up for an event. It will come and go a bit like all the other halvings have, and there's a narrative that can be attached to it, but I don't suddenly see that being the spark of a next bull run. I think coincidentally next year will probably be a very good year in general for crypto from a market cycle perspective, from a rates perspective as well. As soon as we see risk premiums change and interest rates come off in the US, which is probably going to happen by Q3 next year, that also then plays into crypto's hands as well.
So coming to the interest rates, high interest rates are bad for crypto, in your opinion, and interest rates change, how would it affect that?
Well, I think it's, you're up against the mighty dollar. At the moment, people can take no risk with their cash and receive a fairly healthy premium on it. And coincidentally, Bitcoin has very little borrow value at a time like this. When we see that big rotation play out, especially in the alts market where, the funding curves that you see there can get really, really interesting from a trading perspective. But at the moment, risk-free money is is here to stay. It has a number of other effects in terms of stopping certain people who have to pay mortgages, like a lot of us do, from maybe putting excess capital into things like risk assets.
It's true that last year, everyone was a little bit disappointed about the crypto because we thought it would be an uncorrelated market. Like everything was down, and actually the crypto also was down. So now I have to say it's another dynamic. The macro is one thing, but I think also the geopolitics, what's happening now in the world, unfortunately, create for all the crypto market is also, I think, again, when you have difficulties in some country, that's the base to go for some of them.
Thank you very much. And what's the difference between high net worth individuals, family offices, large institutionals in their portfolio approach towards crypto?
Yes, I think you need to separate. If you talk about a high net worth client, what does they want is like a little bit, like the fears of missing out, or just they believe in crypto, so they want to open an account, they want to have secure custodian, secure place to place the token. If you talk about institutional, if I talk about a private bank, us, we trade for our clients, but if we have a token at crypto on our balance sheet, we need to pay up to 800% collateral overnight, which it just shows you that it's different pattern. We cannot take a bet on crypto. We can propose to client, but we cannot. We don't have a balance sheet big enough to own for ourselves. And then if you talk about discretionary mandate and or pension fund, in Switzerland, the only way to have exposure in crypto is to have a mutual fund or a fund of hedge fund. As crypto, it's still called a risky asset. So the only way to have exposure is to buy ETP, ETF fund, a mutual fund. You cannot have direct exposure for a DPM and or pension fund. So that's why actually we have launched a fund of hedge fund in July this year. And we are, I think, one of the few, if it's the only Swiss bank, who allocate a little part of a crypto asset in our DPM.
I think an interesting dynamic that we've seen certainly on the family office, ultra high net worth side is if you go back a couple of years, either they were buy and hold clients, and even in those instances, they would allocate capital to an external broker or trading house that would do the trading for them. We're seeing now, this constant quest for alpha and cost reduction. These firms are now bringing a lot of that trading in-house, and they will be running their own strategies, across multiple asset classes, rather than being capital allocators. And that's been a pretty interesting dynamic because, these entities were traditionally not a great marketplace for risk assets. They were risk averse, they were buy and hold at best, they would very much relationship business as well, which it still is to a certain extent, but seeing these guys actually on the front line of trading, running their own risk, is a pretty interesting dynamic, and I think crypto has actually been a catalyst for that because they're over provided for when it comes to equity, FX, bond trading services, but for a lot of them, they would go to their traditional broker and say, well, I want to take some digital asset exposure, and this broker wouldn't know where to start, right? Or the banks where they would hold their funds. So for them to want to take on some of that exposure, especially when crypto was outperforming the market and a lot of people were generating alpha by having exposure to it, they were forced to bring it in-house, and that's been an interesting dynamic that has now continued.
Yeah, I would definitely say there's varying levels of sophistication, but the choice that is out there now is significantly improved. Whether it's working with a private bank, OTC desk, or a fund of fund, there is a lot of options and different strategies which they can access if they're not willing to do that themselves. In the fund of fund market, for example, you have market neutral funds, basis trading, structured options products, and the demand to access those has significantly increased. And even building to exchange, often that's quite a daunting process for many family offices and high net worths, but we have a number of firms who have built sophisticated API and quant strategies directly onto exchange and interested in things like low latency and high throughput, which has been exciting to see.
Also, with regards to the choice of the digital assets, is it only Bitcoin and ETF that those institutions are currently focused on, or they're trying actually to find some like top 50 coin market cap or top 100 coin market cap, or maybe do some specific bets on some companies that they invest in? What trends do you see there?
Bitcoin and Ether is 70% of the market cap, right? So if you just want an exposure, like you don't want to fear of missing out, you're going to play those two. Then for the young one, the geeks, for sure, they're going to try to find something they understand. And I have to say that maybe we have seen, the really young generation, they want just get rich very fast, so they're going to start to play, shitcoin, altcoin, or everything. But what we can see is really the major, I would not say the top 50, but I would say the top 10. That's what people want. People actually try to understand.
I think the rise of CME futures, and you look at the open interest there, is a huge indicator of where the institutional money is comfortable. If you think of it as a sliding scale of risk versus counterparty risk, the credit worthiness of underlying trading entities that can get comfortable trading outside the top 10 coins, it starts to get pretty interesting. If you go to places like Japan, where their regulator regulates individual tokens or coins, that starts to make the ecosystem a little bit more palatable outside of Bitcoin and Ethereum. Needless to say, you can't trade Tether, for example, in Japan, but things like Ripple are acceptable outside of Bitcoin and Ethereum. I think as soon as we get to a stage where individual coins are regulated to a certain level, and there's some kind of regulatory framework that you can trade them under, rather than just being able to touch crypto in general, because let's be honest, you can have a crypto license, but you can trade under that. You could trade Bitcoin, you could trade, a shit coin, a top 100 coin, whatever it may be, right? I think as soon as there's a regulatory framework that drills down to coin level approval, then you'll start to see a lot more institutional uptake of those tokens, because there is absolutely huge trading opportunity in market inefficiencies alone across all of the multiple venues that stream these coins. But being able to evidence the underlying blockchain, the developers behind it, it starts to get pretty interesting from a DD perspective.
Yeah, I mean, if you look at the top 5, top 10 exchanges, you will still probably see 80% of volume is concentrated to Bitcoin and ETH, and then there's quite a significant drop-off in the other tokens. We're an institutional focused exchange, and we list coins on demand from our clients. And generally, the demand is for the top 20 coins from a market cap and a trading volume perspective is the first things we look at when looking at new coins.
Yeah, thank you. And you touched on the generational change in the institutions, and especially in the high net worth individuals, Valérie. So can you expand a little bit more, like what trends do you see there?
Yes, well, actually we started the project to trade and custody crypto 3 years ago, because we had, the Bitcoin was at 60,000, and we had a lot of clients who actually called me to say, could you talk to my children? They all want me to have exposure in crypto. And that time, we had few ETP, I think 3 ETF, but they said, no, but we really want to have exposure, like direct exposure. So actually, the demand came really from the young generation. And now in the crypto world, I think it's 320 million people who own crypto, which is more or less 4-5% of the population. But it's 20% of the young generation own crypto versus 5% of all. So it's really, if you look at all this university, now almost all of them got blockchain or cryptography class. So it's, they're born with coding. So they understand it a bit probably better than us or than the oldest generation how it works. And so yeah, I think they push a little bit all the crypto asset class.
So from an institutional perspective, and I've been in crypto since 2017, what we've seen is this I talk about hearts and minds and winning that ideological battle. For a lot of bigger institutions, I'm going to sound terribly ageist when I say this, but you had a certain generation of people within the firms who didn't want to put their legacy at risk or their pension. They were closer to retirement, and a new initiative into this strange new ecosystem was just not part of their risk appetite. And you genuinely had to wait for certain people to exit companies from a management committee perspective. And then some of the newer generations that are coming through who are now in sort of risk-taking roles and oversight roles are able to, you know, sort of tip that balance in the favor of looking at this as an asset class. Because, you know, there's still a lot of stuffy institutions that are so far away from even accepting this, just because for them, for certain people within businesses, it's just too much of a risk.
Yeah, I've totally seen that this year. I mean, post all the issues we faced last year, we saw a number of teams basically pivot back into FX and commodity trading. As Cameron said, the money and the influence is held by a few top people in some of the larger firms, and a lot of them didn't have the risk appetite to put their backing behind building crypto teams. And as mentioned before, people don't want to be a market leader, or they don't want to tarnish perhaps their broader brand when they manage billions, if not trillions of assets for a smaller, maybe 1 or 2% allocation to a new asset class. However, I think tides are turning again. Those teams are building out, and we're starting to get some tier one hedge funds and asset managers looking at accessing spot and futures products.
Yeah, thanks a lot. And what's the role of options and perpetuals in the crypto, and why options trading is so low compared to the traditional finance?
Well, I think part of it is capital efficiency for a lot of these firms. If you are trying to access spot liquidity, a lot of venues, pre-funding is, you know, just a huge additional capital inefficiency as well as a credit risk, right? So being able to trade some kind of margin-based instrument makes absolute sense for them. You know, there's some other large tier one banks out there that are only offering access to crypto in the form of some kind of derivative, more from a regulatory perspective because they can't touch spot. But the rise of that market and the fact that CME is now the largest open interest in Bitcoin and Ethereum shows that it's part of any portfolio, and it tends to be sort of the entry point for a lot of these big institutions into the space, just because, you know, enhanced due diligence for a lot of venues to access spot is still problematic for them.
Capital efficiency is the key word that comes up when institutions are looking to trade digital assets. Fully funding 6-7 exchanges, trading the top 50 coins, holding that on your balance sheet is less than ideal. So being able to use maybe just Bitcoin or USDC, USDT as collateral to trade 20, 30 assets is just far more appealing, and it looks and feels a lot more like the traditional futures or derivative contract they've traded in the past.
Absolutely. And what about Deribit? Deribit is holding like about 95% of all options trading, like roughly speaking. So do you think that there are some emerging players, or maybe someone from institutions that would come in and kind of tackle their dominant positions on the market?
I'd imagine, I'm going to pass this to Cameron, given that the traditional options market is mainly traded OTC. So are you seeing that shift in crypto?
Well, Deribit did a great job of maintaining market share whilst being based in a very difficult jurisdiction to face, being Panama. They're actually setting up shop here to face clients. I think if you have a broader trading relationship with a larger entity, and so for example, you know, here at Laser, under Nomura's umbrella, we offer multiple products to clients and effectively want to be able to hedge any of their underlying spot exposure. The options market is the youngest market in crypto. Outside of Bitcoin and Ethereum, there really isn't a huge amount of liquidity, but there's a number of coins that you look at. You look at the use cases, the growth in liquidity, that trajectory over the past couple of years, they're probably absolutely ripe for some kind of explosion in their options pricing. You've got to remember as well, this is a very young market for structured products too. And that component, the options component to those, there's only a couple of players out there that are genuinely selling some kind of structured product on commercial paper. So again, you can see just, you know, the traditional life cycle of financial products, the growth there is going to be absolutely enormous. Also things like covered call strategies, you know, just the basics that you take from traditional financial options strategies, they just don't really exist as much in crypto. People are not necessarily hedging their exposure as much. You're certainly not seeing that many people writing options in crypto either. And part of that comes down to slightly immature risk management as well. But you know, that is the next big boom in the market for sure.
Thanks a lot. I think our time comes to an end, but I would like to ask you for one final remark for our audience about the institutions and about the crypto in general, and about maybe the trends on how you see it evolving, and whatever you can just give it as an insight to the audience.
I think the infrastructure needs to be. I mean, we're still working on. I have to say the journey is not over, but it's definitely here to stay. I think you need to choose the product which is going to be good for you. Can be ETP, ETF, can have, but you need to understand what you do, and you need to, always check the risk of the product you're going to choose.
This has been a roller coaster ride. This has been a tough neighborhood over the past couple of years. But right now, with everything that's happened, it has never been cheaper, more technologically accessible to trade the underlying spot market in crypto versus, you know, tier one rated counterparties. So, you know, we're having a number of really interesting conversations with firms where their entry point is now into this marketplace, whereas previously they just weren't comfortable building out any kind of trading services or functions with the level of creditworthiness that was around there.
Yeah, I mean, it's been a tough year. Volatility has been depressed. We've seen definitely a pullback in building out to crypto. However, definitely seeing green shoots, and I think never more than ever have we have such a choice of trusted counterparties, whether it be for trading, OTC, on exchange. And I think now that counterparty risk has come to the forefront of the narrative, you have an unbelievable choice to get to digital assets.
Thanks a lot for the panel.